Hello and welcome. In this lecture video, we'll continue our discussion of Chapter 3. We'll talk about accrued expenses, the adjusting journal entries for accruing expenses, and also for accruing revenue. Okay, so when we talk about accrued expenses, we're talking about costs that are incurred in the accounting period, but are not yet recorded and they haven't been paid. So we've experienced this cost. This cost has been incurred during the year, but we haven't recorded it yet and we haven't paid it yet. So some common examples would be salaries, interest, and rent. Okay, so let's look at an example of salaries expense because this one really is a good example. So let's say we have an employee, our fast forward employee earns $70 a day and is paid every 2 weeks on Friday. Year-end 12/31 falls on a Wednesday. Okay, so if I look over here, this is our first year. This is our current accounting period. This is our next accounting period, and we can see over here the last payday of the year is Friday, 12/26, and from 12/26 until year-end 12/31 is 3 working days. So on 12/26, that's the last date paid. Okay, so it's the last time we recorded salaries expense and paid salaries. And then what we say is on 12/31, on the 29th and the 30th and on the 31st, we have our employee has worked 3 days, but we're not going to pay them until the 9th of the next accounting period. Next accounting period, and the next payday is January 9th. Okay? So the last time they got paid was 12/26. The next time they get paid is January 9th because they're paid every 2 weeks. But we have these 3 days that occurred in accounting period 1 that they're not going to be paid for until accounting period 2. So when we think back to what we were defining accrued expenses as expenses that have been incurred but not yet recorded and not yet paid. So we have the salaries expense for these 3 days that we have not yet recorded. We have to record that at the end of the year. We have to do an adjusting journal entry to record 3 days worth of salaries expense, even though they won't be paid until the next accounting period. Now, why do we need to do that? Because of the matching principle. These employees have helped us to generate revenue, right? They've helped us to generate revenue and to maintain business operations. And so because of that, we have to recognize the expense of paying their employment in the period in which they worked, which is this first accounting period. So on 12/31, we're going to do a journal entry. I'll come down here and write it. 12/31, we're going to accrue for salaries expense. So how much will we have to accrue salaries expense? Well, it's $70 a day times 1, 2, 3 days, the 29th, 30th, and 31st. 3 days. That's $210. Okay? So what we have to do is on December 31st, we're going to debit salaries expense for $210. And then we don't pay them, right? We don't credit cash. We'll credit cash on the 9th. So what do we credit? Well, we have a liability because we owe them money. They have worked, but we haven't paid them yet. When do we pay them? On the 9th. So we have a liability. So we have what we call a salaries payable. Now, how does this journal entry keep the accounting equation in balance? Assets are not affected at all, but liabilities are going up by $210. Expenses are going up by $210, which means equity goes down by $210. Liabilities go up by $210, equity goes down by $210. The accounting equation stays in balance. So the journal entry that we would do on 12/31 to accrue salaries is debit salaries expense, credit salaries payable. Now, on the next accounting period, the next year, January 9th of the next year, we have to pay our employee. We have to pay our employee. Okay? Now it's 2 weeks. Well, that's 2 weeks worth. So it's going to be $70 a day, 2 weeks, right? It's 5 working days in each week. So that means 10 working days. 10 working days times, and we pay them $70 a day, gives us $700. So we have to pay them $700. Whenever I say pay something, what do you automatically think? I hope you think credit cash, because that's what you should be thinking. It's a credit to cash for $700. We know that right off the bat. Okay? But if we look back over here, we also have to recognize salaries expense. Okay? How much salaries expense do we recognize? Well, it's 1, 2, 3, 4, 5, 6, 7 days worth times our 7 days times our 70, $490 worth of salaries expense. Okay? And then, if you think about it, look at this, salaries payable right over here, I have right here. I'm going to pay that off. I'm going to pay them the money that we owe them on the 9th, right? So this salaries payable is going to go away on January 9th once I pay them. So the liability is going to go down. So in terms of debits and credits, I'm going to recognize $490 worth of salaries expense. $490 worth of salaries expense in this second year. And then I recognize an expense with a debit. And then I will then debit salaries payable for that $210, which is how much I put up on the balance sheet at the end of the last accounting period, because I'm paying for that. And how do I decrease the liability? A debit. So I will decrease the liability with a debit. So I decrease this liability, salaries payable, by debiting salaries payable for $210. And then, what do you think I credit? Cash. To pay them. So I have my debit to salaries expense for $490, which is the 7 working days in the second accounting period, times the $70 a day gives me $490. I debit the payable that I did on 12/31 of the last accounting period, because we don't owe them that money anymore, so the liability goes down. The way I make a liability go down in terms of debits and credits is with a debit. What do I pay them with? Cash. Cash is going down. How to recognize that cash is going down? With a credit. Why a credit? Because cash is an asset. The way to decrease an asset is with a credit. And that's our journal entry. Let's take a look at another example of accruing expenses, and that's for interest expense. So when a company takes out a note payable, right? Maybe they borrow money from a bank. Let's say they borrowed money from a bank. That would be a note payable. Okay? That note, just like if you borrowed money to purchase a car, comes with interest expense. So what we have to do is we have to recognize interest expense at the end of the accounting period. We have to record or accrue interest expense at the end of the accounting period. Okay? So if we look at this example, our company borrowed $6,000 from First National Bank on December 1st. So on 12/31, what we do, on 12/1, let's look at that. On 12/1, they borrowed money. So what do we get? We get cash. We debited cash for $6,000. And then what we have is a note payable. Notes payable for $6,000. This note's payable, so you debit to cash because cash is going up. Credit notes payable. Notes payable is a liability. How do I recognize that a liability goes up? Is with a credit, $6,000. Debit cash, credit notes payable, $6,000. Okay? Now it says right over here, the note bears interest at the annual rate of 6%. That's 6% per year. And it's going to be repaid We're going to pay this $6,000 back with interest in 1 year. But what we have to do is on the 31st, we have to recognize 1 month's worth of interest because we have to recognize it in that accounting period. We have to record it in that accounting period because it was incurred in this accounting period. So I have to record it in this accounting period. And how long? 1 month. Well, here's the tricky thing. If I multiply my 6,000 times 0.06, that's interest for the whole year. I don't have it for a full year. I only have it for 1 month. So I have to adjust, I have to do a formula to help me figure out how much interest I would pay for 1 month. And that formula is I take my principal, which is the amount that I borrowed, that's called my principal, times my annual interest rate times the fraction of the year since the last payment. And then what we do when we do interest calculations, just for this class, okay, just to make calculations easier, we assume a 360-day year. And we do that just to simplify the calculations, okay? So assume a 360-day year. So when we're applying this formula down over here, we can take our 6,000, which is our principal, times our annual interest rate, times the fraction of the year. Well, it's 30 days, right? First to the 31st, 30 days divided by the 360, the full year, okay? And what that gives us is $30. So on 12/31, I'm going to recognize 1 month's worth of interest expense. Well, how do I recognize an expense? The debit. So I'm going to debit interest expense for $30. And then I have to recognize that I owe that interest expense. I owe that interest expense, but I'm not going to pay it back for 1 year, but I still owe it. And so what I'm going to do is recognize a liability. Credit my liability of interest payable for $30. So I have my debit to interest expense and then my credit to interest payable for $30. Okay? Let's take a look at accrued revenues. So our accrued revenues are revenues in a period that are not yet recorded, and we haven't received cash for those revenues yet. Those can be for situations, remember, we've provided some consulting services, but we haven't yet been paid, and we haven't recorded the fact that we've earned revenue. That would be the situation over here. So we provided some consulting services. We haven't recorded that we've provided those consulting services, and we also haven't been paid yet. So we have to record that we've earned some revenue. We've earned those recorded revenues. We have to record those revenues. So on 12/31, so on 12/12, Fast Forward agrees to render consulting services under a 30-day fixed fee contract for $90 a day. All services will be completed January 10th the next year when the client pays. On 12/31, we have to say from the 12th through the 31st, we have 20 days. Times $90 a day gives us $1,800. So what we're going to do is we're going to debit accounts receivable for $1,800. And then we will credit consulting revenue. And what this does is it recognizes the revenue. We record the revenue. Even though we haven't been paid yet, we can still record the revenue. Why can we do that? Because of the revenue recognition principle. The next period, when we get paid, well, we receive cash. So this is on 1/10 of the next counting period. We debit cash, $2,700. We no longer have this accounts receivable, so I credit my accounts receivable for my $1,800, and then I will credit consulting revenue right over there for the balance of $900. Thank you.